Most traders believe they have vetted setups, but what they actually have are patterns they've noticed and liked. And the difference between those two things is the difference between confidence that is earned and confidence that is assumed. Vetting is a specific process with a specific outcome, and it starts with a question most traders have never honestly answered. Can you define your setup clearly enough that someone else could identify it without asking you a single question? Because if the answer is no, then the setup exists as a feeling, not as a defined set of criteria, and feelings cannot be vetted. The vetting process has 3 stages that build on each other, and skipping any of them means the work is incomplete, which means the confidence that should come from vetting has no solid ground to stand on. The first stage is definition, writing down exact entry criteria in measurable terms, not strong momentum or clean setup, but specific price conditions, specific time frame alignment, specific candle behavior that anyone could identify using the same words you used, because vague criteria produce inconsistent execution, and inconsistent execution produces results you cannot evaluate. The second stage is historical testing, taking those exact criteria and applying them backward through a meaningful sample of market data. Not cherry-picking the obvious winners, but finding every instance where the criteria were met and recording the outcome. Because your memory of how a setup performs is almost always more optimistic than reality. And the only way to know what a setup actually does is to look at what it actually did across enough instances to be statistically meaningful. The third stage is confirmation of expectancy, reviewing the outcomes of the historical test and calculating whether this setup, as defined, produces positive expectancy over the sample, meaning the average winning trades more than cover the average losing trades at the frequency they occur. And if they do, you have a vetted setup. And if they don't, you have a setup that needs refinement before it earns the confidence you've been giving it. What changes when a setup is genuinely vetted is subtle but profound. The anxiety before a trade shifts from, "I wonder if this will work," to something more grounded. Because now you know it works over the sample, you know the win rate, you know the average outcome, and you know that this trade is one instance in a larger series that has a positive expectancy you've confirmed, not assumed. The trap most traders fall into is taking a shortcut between noticing a pattern and calling it vetted, because noticing that a pattern seems to work feels like research, and believing it strongly feels like confidence. But neither of those things is the same as the work of actually testing it across a real sample and confirming the numbers support your belief. The practical test is simple. If someone asked you to show them the historical performance of your primary setup, could you? Because if you cannot, it isn't vetted, and the confidence you feel about it is borrowed from optimism rather than earned through evidence. Vetting doesn't make trading easier in the sense of making individual trades feel certain, because individual trades are never certain, and vetting doesn't change that. But it makes trading easier in the most important sense. When a setup appears, there is nothing left to figure out, nothing left to analyze. No uncertainty about whether this is the right setup because you already resolved that question before the session began. The starting point this week is honest. Pick your primary setup, write down its criteria in measurable terms, and ask whether those criteria have been tested against a real sample with real outcomes recorded. Because the answer to that question tells you whether your trading is built on evidence or optimism. And evidence is the only foundation that holds up when trading gets difficult.